The missiles were still in the air, the fires were still burning across refinery lines in the Gulf, and every expert said the same thing. Hormuz will close, the oil will stop, China will panic. But then, something happened that nobody predicted. 11.7 million barrels moved silently through a war zone, not before the war, not after the war, during it. And the most disturbing question isn't how, it's who allowed it, and why. Welcome to Currency Archives, the channel where money tells the story that the news refuses to. Now, before we go any further, if you're someone who's lived long enough to know that the real game is never what's shown on television, do us a favor, hit that subscribe button. Think of it as passing down wisdom to the next generation. You've earned that right. And while you're at it, drop a comment below and tell us, where in the world are you watching from? Because this story affects every single one of you, no matter where you are. The missiles were still in the air. The fires were still burning across refinery lines in the Gulf. Insurance companies had already begun pulling coverage from tankers operating anywhere near the Strait of Hormuz. Shipping executives in London and Singapore were on emergency calls. The United States Navy had repositioned 2 carrier strike groups into the region. Every financial model, every geopolitical risk desk, every analyst who had spent years studying Middle Eastern energy markets was saying the same thing. The oil would stop. It had to stop. Because that is what wars do. They interrupt. They destroy. They sever the arteries of global trade and force the world to find new paths forward. History had proven this repeatedly. When Iraq invaded Kuwait in 1990, oil markets went into immediate shock. When the Suez Crisis erupted in 1956, energy routes across the Mediterranean collapsed overnight. The logic was consistent, the precedent was clear, and the conclusion seemed inevitable. Hormuz would close, the oil would stop, the world would scramble. Except it didn't. While governments were issuing emergency statements and television networks were broadcasting footage of burning infrastructure, something else was happening. Something quieter, something far more significant, and something that most of the world completely missed. Tankers were moving. Not away from the Strait of Hormuz, through it, carrying Iranian crude oil, heading east, toward China. Between the moment the conflict escalated and the weeks that followed, satellite tracking data and independent shipping analytics recorded a figure that stopped serious analysts in their tracks. Iran had successfully moved 11.7 million barrels of oil through the Strait of Hormuz, the same waterway the world had declared a war zone, and delivered it directly to Chinese ports. 11.7 million barrels. To put that number into context, that is enough oil to power the entire United Kingdom for more than 3 weeks. At wartime market prices, the dollar value of that single shipment sits comfortably above $700 million. This was not a trickle. This was not a symbolic gesture of defiance. This was a fully operational large-scale energy transfer executed in the middle of an active military conflict. The question is not whether it happened. The data confirms it did. The question is how. And more importantly, why did no one stop it? To understand the answer, one must first understand what the Strait of Hormuz actually represents in the architecture of global energy. The strait is a narrow waterway, at its most critical point only 33 kilometers wide, sitting between Iran to the north and Oman to the south. Through this single corridor passes approximately 20% of the world's total oil supply. Every major oil-producing nation in the Gulf, Saudi Arabia, the UAE, Kuwait, Iraq, and Iran itself, depends on this strait to move its energy exports to global markets. This is not simply a geographical fact. It is a strategic reality that shapes the behavior of every major power on Earth. The United States maintains a permanent naval presence in the region, specifically because of Hormuz. China has spent decades quietly securing alternative energy relationships because of Hormuz. Iran has, for years, used the threat of closing Hormuz as its most powerful geopolitical card. And yet, when the moment of maximum tension arrived, the strait did not close. The tankers did not stop. The oil kept moving. Analysts who study Iranian energy policy were not entirely surprised. They had seen the pattern before, in smaller conflicts, in periods of elevated tension, in the quiet months between public confrontations. There is a fundamental truth about energy trade that wars rarely override. Economic necessity is a more powerful force than military posturing. Iran needed the revenue. China needed the oil. And the infrastructure built over years to move that oil quietly, efficiently, and invisibly was already in place long before the first missile was fired. The 11.7 million barrels did not move by accident. They moved by design. And understanding that design, understanding who built it, how it operates, and why it continues to function even as the region burns, is the key to understanding something far larger than a single wartime shipment. It is the key to understanding how the rules of global energy trade have already changed, and almost no one noticed. There is a fleet that does not exist. It carries no official markings. It transmits no location signals. It files no honest paperwork with maritime authorities. Its vessels change their names the way other ships change their flags, routinely, quietly, without announcement. If you search for these tankers in standard shipping databases, you will find gaps where vessels should be. Blank coordinates, vessels that vanished mid-ocean and reappeared thousands of miles away under entirely different identities. The shipping industry calls it the shadow fleet, and it is the single most important piece of infrastructure in the Iran-China oil trade. To understand how 11.7 million barrels moved through an active war zone without triggering a global crisis, one must first understand that this shipment did not rely on conventional logistics. It did not use Western-insured vessels. It did not pass through systems monitored by American financial institutions. It did not touch a single bank that answers to the United States Treasury. It used a parallel system, one that has been quietly under construction for nearly a decade. The architecture of this system is more sophisticated than most people realize. It begins with the tankers themselves. Iran maintains access to a fleet of vessels, many of them older ships purchased through intermediaries in countries with minimal regulatory oversight, that operate entirely outside the Western maritime surveillance framework. These ships routinely disable their automatic identification systems, the transponders that allow satellites and port authorities to track a vessel movement in real time. When a tanker goes dark in the Persian Gulf and reappears 3 weeks later in a Chinese port flying a different flag with a different name, the paper trail between those 2 points is deliberately, professionally, and completely erased. But the shadow fleet is only the beginning. Once the oil is loaded and the tanker moves east, the financial transaction that pays for it must also move, without touching the Western banking system that would immediately freeze it under sanction protocols. This is where China's role becomes far more significant than simply that of a buyer. Chinese state-affiliated entities have developed alternative payment mechanisms specifically designed to settle commodity trades outside the dollar system. Some transactions are settled in Chinese yuan through channels that bypass SWIFT entirely. Others involve complex barter arrangements, Chinese manufactured goods, technology transfers, or infrastructure investment flowing into Iran in exchange for oil flowing out. The transaction is real, the money moves. But it moves through architecture that Western regulators cannot see, cannot freeze, and cannot stop. This is not improvisation. This is years of deliberate engineering. Iran learned from Russia. Russia learned from Iran. And both learned from watching what happened to every nation that relied entirely on Western financial infrastructure when geopolitical relationships turned hostile. The lesson was the same every time. If your economic survival depends on systems controlled by your adversary, your economic survival is permanently at risk. So they built their own systems. And wartime, it turns out, is not when those systems get tested for the first time. Wartime is simply when the world finally pays attention to systems that have been operating quietly for years. China's motivation in this arrangement goes beyond simply securing cheap oil, though the discount Iran offers to sanctioned market buyers is significant, often running 10 to 15% below prevailing market rates. China's deeper strategic interest is in demonstrating both to itself and to the world that its energy security does not depend on American goodwill or Western institutional cooperation. Every barrel China purchases from Iran during an active conflict is a data point in a larger argument that the energy architecture of the 21st century does not have to run through Washington. And Iran, for its part, is not simply surviving, it is selling at wartime prices into a market desperate for supply certainty, to a buyer with both the infrastructure and the political motivation to keep purchasing regardless of what Western governments demand. The 11.7 million barrels did not move through chaos. They moved through a system so carefully constructed that the conflict happening around them was, in operational terms, almost irrelevant. The war was loud. The oil trade was quiet. And quiet in global economics almost always wins. There is something even more uncomfortable waiting beneath this story. Something about a threat Iran has used for decades, the threat to close Hormuz entirely. And why? When the moment finally came, Iran chose not to use it. For 40 years, Iran held a gun to the world's throat, and the world believed it. Every time tensions escalated in the Persian Gulf, every time Washington tightened sanctions, every time Tel Aviv issued a military warning, Tehran responded with the same threat, delivered through state media, through military commanders, through the carefully chosen words of senior IRGC officials, who understood exactly what those words would do to oil markets the moment they hit the newswire. We will close the Strait of Hormuz. Oil prices would spike within hours. Insurance premiums on Gulf shipping would surge. Emergency meetings would be convened in Washington, Brussels, and Beijing. The threat alone, not the action, just the words, was enough to move the global economy. For 4 decades, that threat was Iran's most powerful weapon. And then the war actually came. The moment that Iran's generals had publicly promised for years finally arrived. Active military conflict in the region, Western naval assets repositioned, Gulf infrastructure under attack, the world watching Hormuz with genuine fear for the first time in a generation. And Iran did not close it, not even for a single day. The question that serious analysts began asking in the weeks that followed was not whether Iran lacked the military capability to close Hormuz. It possesses mines, anti-ship missiles, drone swarms, and submarine assets specifically designed and publicly acknowledged to be intended for exactly that purpose. The capability was never in doubt. The decision was, because closing the Strait of Hormuz is not a weapon Iran can fire without shooting itself. This is the central paradox that Western strategic analysis has consistently underestimated, and that Iran's own military planners understand with absolute clarity. The Strait of Hormuz is not just the exit point for Saudi oil, Emirati oil, and Kuwaiti oil. It is the exit point for Iranian oil. Every barrel that Iran sells to China, every shipment that funds the government in Tehran, every dollar of revenue that keeps the Iranian economy from complete collapse, it all moves through the same narrow corridor that Iran has spent 4 decades threatening to close. Closing Hormuz would be the economic equivalent of Iran cutting off its own oxygen supply. The threat was always designed to be believed, never to be executed. But there's a second layer to this calculation that goes even deeper. Iran's decision to keep Hormuz open during active conflict was not merely about protecting its own revenue stream. It was a deliberate strategic signal directed at 3 specific audiences simultaneously. The first audience was China. By keeping oil flowing under maximum pressure, Iran demonstrated to its most important economic partner that it is a reliable supplier, even in war. That reliability has a dollar value that extends far beyond the current conflict. It is an investment in the relationship that will matter long after the missiles stop. The second audience was every other sanctioned or semi-sanctioned nation watching from the sidelines. Russia, Venezuela, North Korea, and others who are quietly building their own parallel economic architectures. Iran's message to them was precise. The system works, even under fire. Keep building. The third audience was Washington itself, because there is nothing more unsettling to a sanctions regime than the discovery that the sanctions are not working. The entire architecture of American economic warfare depends on the assumption that cutting a nation off from Western financial systems will eventually force behavioral change. Iran, by continuing to export oil at scale during an active military conflict, was sending a direct message to every strategist in the Pentagon and the Treasury Department. Your tools have limits. We have found them, and we are operating comfortably beyond them. The Gulf states quietly registered this message with significant alarm. Saudi Arabia, the UAE, and Bahrain had spent years under the assumption that American economic and military power would ultimately contain Iranian ambitions. What they watched instead was Iran executing a wartime oil trade worth hundreds of millions of dollars through their neighborhood, past their coastlines, through the strait that their own economic survival depends upon. And nobody stopped it. Global insurers had already begun quietly recalibrating their risk models for Gulf shipping. Shipping companies that had publicly pledged to avoid Iranian cargo were privately making exceptions through third-party intermediaries. The institutional response to Iran's wartime trade was not confrontation. It was adaptation. Because the world still needed the oil. And the oil was still moving. What that movement revealed about the future of global energy power, about the fracturing of the systems that have governed international trade for 70 years, is the most important part of this story, and it is the part that nobody in a position of power wants to say out loud. The old world had rules. Oil was priced in dollars. Transactions cleared through Western banks. Shipping was insured by Lloyd's of London. Sanctions were enforced through financial systems that every serious economy on earth depended upon. And any nation that stepped outside those rules faced a simple, brutal consequence. It was cut off from capital, from trade, from the global economy itself. That system ran the world for 70 years, and 11.7 million barrels of Iranian oil moving quietly through a war zone toward Chinese ports just told the world that the system is breaking. Not broken, not dead, not replaced, but breaking, visibly, irreversibly. And the speed at which it is breaking should concern every serious businessman, every entrepreneur, and every investor who has built their understanding of global markets on the assumption that the old rules still apply. Here's what the data actually shows. Iran is not the only nation building parallel energy infrastructure outside the Western system. Russia, following the sanctions imposed after 2022, accelerated the construction of its own shadow fleet, now estimated by independent maritime analysts to consist of over 600 vessels operating outside Western insurance and tracking frameworks. Venezuela has quietly expanded its own off-grid oil export network. The pattern is consistent across every sanctioned energy producer on Earth. When the Western system closes its doors, these nations do not collapse. They build different doors. And China is the architect standing behind all of them. China's role in this emerging energy architecture is not passive. It is not simply buying discounted oil from desperate sellers. It is actively constructing the financial, logistical, and diplomatic infrastructure that makes these trades possible at scale. The yuan-denominated oil settlement system that China has been developing since 2018, once dismissed by Western analysts as an ambitious but ultimately marginal experiment, processed a record volume of transactions in the months surrounding this conflict. The petrodollar system, the arrangement under which global oil trade has been settled in American dollars since the 1970s, is not collapsing overnight, but it is losing market share, quietly, consistently. And with every wartime barrel that moves from Iran to China outside the dollar system, the argument for maintaining dollar dependency becomes slightly less compelling to every energy producer watching from the sidelines. This is the shift that matters most to the business community, because the fracturing of the dollar-dominated energy system does not only affect geopolitics. It restructures the risk calculations that businesses, investors, and entrepreneurs in every sector must make about where value is stored, how supply chains are secured, and which institutional relationships will remain stable over the next decade. Consider what the 11.7 million barrel story actually reveals about supply chain resilience. The conventional wisdom, that conflict disrupts supply and forces prices higher until stability returns, failed to account for the existence of a fully operational parallel supply network that does not respond to the same pressure points as the conventional system. Businesses that built their risk models on conventional assumptions were caught off guard. Businesses that understood the parallel architecture were not. This is the competitive advantage that serious economic literacy provides. The entrepreneurs and investors who will navigate the next decade most successfully are not the ones who follow the loudest headlines. They are the ones who understand the quiet systems, the shadow fleets, the alternative settlement mechanisms, the bilateral energy agreements being signed in languages that Western financial media does not prioritize. They are the ones who ask, when the missiles are flying and the experts are unanimous, what is actually moving beneath the surface? Iran's 11.7 million barrels answered that question with remarkable clarity. Beneath the surface of a war that dominated every headline, a multi-hundred-million-dollar energy transaction was executing flawlessly. The infrastructure that made it possible had been built over years, tested over years, and refined over years, specifically in anticipation of the moment when it would be needed most. That infrastructure now exists. It is not going away. And the nations, institutions, and businesses that refuse to acknowledge its existence are not operating in the real world of global energy trade. They are operating in a version of that world that ended quietly, somewhere between the first missile strike and the 11.7 millionth barrel, that nobody was supposed to see. The rules have already changed. The only question left is, are you positioned for the world that is already here?